So, what does this tell us about NIO right now? Well, we can see these sharp bounces, for sure, things you could maybe trade. But what it doesn't have is that sustained, rising long-term momentum that our playbook demands. This chart is basically screaming choppy and fragile, not new bull market.
All right, on to Chapter 2. Because a healthy-looking chart is completely meaningful if the company behind it is fundamentally broken. At the end of the day, price always follows the fundamentals.
And this chart right here clearly shows the first major fundamental problem for NIO. The company is consistently losing money. This line is its earnings per share over the trailing 12 months, and you can see it's remained deep in negative territory.
Now that earnings problem immediately creates a valuation problem. The most common metric we all use, the price-to-earnings or PE ratio, is totally useless here. Because the E for earnings is negative, the entire ratio is negative. That means you can't use it as an anchor to figure out what's cheap or expensive. It's like trying to navigate without a compass.
Just to put this into perspective, compare it to profitable automakers which trade at around 7 to 8 times their earnings, or the broader S&P 500, which is up around 25 to 30 times.